From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny. We're going to count you down to the open, but pump up the volume when it comes to TSMC. Their volume of chip sales up 60%. That creates a bid to the whisper number for NVIDIA. You got it. We're going to count you down to the open right now. Stocks are bid. Good morning. Coming up in the show, futures rise, stocks close in on yet another record. The Fed's big tour continuing with Bowman and Kashkari, and the White House prepares to hit China with new tariffs. We begin with the big issue, looking ahead to the U.S. CPI.
CPI next week, if it was to miss or to beat, it could really change the narrative over the next couple of weeks. But right now, we're just kind of in that wait mode. So when Fed officials come out right now, the next meeting, June 12th, is kind of baked in the cake. So we all know that there will be a lot more data before the meeting after that.
Mike McKee is with me. We're tracking the Fed speak. I wonder, will it just be a reissuance of the San Francisco Fed from yesterday? They're all waiting for more confidence. Mike.
You like a choir that sings in harmony, don't you? I do have some good news for you, Manus, and for everybody out there as well. You can take Thursday and Friday of next week off because the data really won't matter. But you got to be there on Tuesday and Wednesday because PPI on Tuesday and Jay Powell speaks on Tuesday. Wednesday, the CPI and retail sales. Now, the interesting thing about the CPI forecast is that it is supposed to go down. You can see the red lines there. That's the forecast. It went up in the last couple of months, and that worried a lot of people. If it goes down, that could reassure the Fed that we are headed in the right direction. Won't mean they will change rates immediately, but it will get them back on track and maybe change the conversation on Wall Street, in Washington, too. Then we also have PPI and retail sales, which will matter to the markets. PPI, we want to see the same thing, it going down. Retail sales expected to drop off significantly. There's an Easter seasonal in there. If that doesn't happen and we have strong retail sales, and some analysts think we will, then that would also change the narrative and put a lot of competing ideas out there. Before we get there, though, we got to get through today, Friday. There's only one number that really matters, and that's the University of Michigan. And we know sentiment is down. But what we're watching is the inflation expectations numbers. Now, the problem is everybody watches those. The Fed makes a big deal out of them. But as you can see, this is inflation the year after the Michigan numbers. And the folks, after about 2010, stopped getting it right. They missed the fact that inflation was going way down. Then they missed the fact that inflation was going way up. So we're not sure how much it tells us. But as long as it tells the Fed something and they care, then we're going to care, and you got to stay around. You can't head out for your weekend until after that's over at 10 o'clock.
Okay, all eyes down for that, and then we can perhaps leave for the day. Hoodwinked by the data. Mike, thank you very much. Let's continue the conversation. My guests are ready. It is Michael Purves of Tallbacken and Bob Dole of Crossmark. Michael writes this: the upward drift in equities is likely to continue. The Fed is in a tweaking cycle, not a cutting cycle, and that means lower volatility, which by extension reduces equity market volatility. Good morning, gentlemen. Good to see you. Mr. Purves, good morning. Bob, so we're on a three-week rally. We've sniffed out this 5,200 level again. We're inches away from another record. Do you share the bullishness? Michael, good morning. You first.
Manus, well, part of what I'm sort of seeing here is that we've had, after several years of extraordinary volatility in economic data and, of course, and Fed policy and all that, we're actually edging into a much sort of slower moving process here. The Fed is, I've been arguing, really is in a tweaking cycle here. We did, of course, have an important series of Fed meetings, and there's one around the corner. Yeah. As well. But I think what's important here is that, the big move here over the last few months has been, the 7 cuts got repriced to 1. Maybe it's now more like 2. We'll see here. But it doesn't really impact that. Whatever's coming out of the Fed is going to be much more minor adjustments at this point here, right? I think there's a more interesting story on the back end of the curve. there with term premium that I think is an important discussion topic there. So far, we haven't really seen much term premium built into the whatever rise in the back end yields we've seen there. But it's important to step back that, look, we're through the earnings season. We are through, a series of key Fed meetings and some repricing along the curve. There's not a lot of near-term catalysts here. That's why I've sort of said sell vol in May, go away, not necessarily sell equities in May there. But I think I'm expecting a lower VIX here, certainly for the near term.
Okay, write those options, take in the premium and deliver some enhancement. Bob, good morning to you. Look, whatever way you cut this up, there was a shift in gear and risk yesterday on the back of, we can debate whether it was idiosyncratic pip higher on the jobless claims. There has been a shift, and that shift has been, again, based on 2 rate cuts. 50 basis points of cuts is in of itself enough to reestablish a pro-risk stance. Or what else was it, Bob?
Well, the earnings have come through well also. I think we have to comment that those first quarter numbers have been pretty good, especially at the bottom line. Revenues a little bit more mixed. And that's my concern. The big hook up in earnings expected by the consensus in the second half, double-digit earnings growth this year, double-digit earnings growth next year, all in the backdrop of a consumer, particularly at the lower end, that's showing some signs of wear and tear. So the vigor of this recovery off that mini correction has been surprising to me, and I think we'll have more turmoil as we go on.
Bob, do you think more wear and tear for the consumer? I mean, I'll throw these names at you. We've used them all week. Starbucks, Uber, Airbnb. I could go on, but there is undoubtedly some pressure on the consumer.
I agree, and if you go to the macro data, when you look at lower-end consumers, they're beginning to struggle. Are their incomes enough? The evidence that they're beginning to tap their credit cards, even some 401k rating. None of that is sustainable, so I think we have to watch that carefully. And look, I don't want to make a big deal about it, but the employment number for the monthly jobs number was a little weaker than expected. Initial unemployment claims picked up. I know there are all kinds of excuses, New York, spring break, all that good stuff. But I think we have to watch that carefully. We expect the consumer will slow some.
Yeah, we both, all three of us need to accept that there is a massive wealth gap and that wealth gap is becoming even more apparent. And I would say it's becoming even more apparent in this data and in these results. But we're not here to debate perhaps the wealth gap today. I do want to understand, Michael, from you, you talk about camping out. You've reflected on periods gone by when the Fed has camped out for a long and enduring period of time. Here we are. The market has repriced 2 rate cuts. So the rate camp, they may be packing up the tents soon. We go to June, we go to PPI and CPI next week, then we float into June. When do you think the Fed wraps up the tents and moves out of the camping out zone on rate cuts?
Yeah, and just to clarify, what I mean by camping out in the note in the work I've been doing is really that when the Fed got to terminal, that it would just kind of stay there, and it would stay there because the inflation dynamics are so complicated in this cycle. There's so many new forces that are coming. There's so many. It's a sort of an odd mix-up of deflationary and new structural inflationary forces all colliding at once. That with that backdrop, the Fed needs as much optionality as it can, and while the Fed is usually in motion, right, they're usually increasing or decreasing their policy rates more than they're doing nothing. This was a period that when we got to terminal last summer, that we would really just. It was my expectation that we would stay here for a very long period of time there. So that said, I do think that look, could we get a cut or two? Absolutely. There, particularly if what Bob is saying, that we start seeing, some more erosion on the lower end consumer on their economic sustainability there, particularly with, still robust gasoline and food prices there. So there, but, what drives the Fed to into a proper cutting cycle? It's got to be something that is a very major economic contraction. You're going to have to see unemployment back up in the high 4s, I think. Mm-hmm. You're going to have to see, PMIs down, not in the high 40s, but in the low 40s or 30s, real economic contraction. there's no reason why this economy, if I'm even just partially right that we're going into some sort of a newer, higher nominal GDP regime, that if we are going to do that, that we should be able to sustain higher positive real rates as we have in so many cycles before. It just wasn't in the cycle we just knew in the few years leading up to COVID. You know, there where we all got inured to very low nominal and real interest rates and this sort of low-fashion narrative. I just don't think we're normalizing back to that. I've been maintaining for some time that we're normalizing to something different than that.
Well, we've been through a heck of a lot, haven't we, in the past 10 days, from the ECI, the convulsing of the ECI, to the relief that you got from the jobs report, to a number of other sort of the economic surprises are also disappointing if you look at that. I want to just throw this at both of you. This is from Stephen Major, the most latest note, so I want to get your perspective on the bond market. We restore our conviction. We restore a bullish conviction on US Treasuries for this month's asset allocation because valuations versus, and here's the kicker, gentlemen, versus the rest of the world. So Stephen has raised his bond target to 3.5 from 3, so there's an incremental move. But again, bullish on bonds, and this is the top line. So again, Bob, here we are. We saw my word of the week has been recalibration in rates from the start of the week to over the past 10 days. If these incremental slowdown in data continue, is that enough in itself to re-enter bonds? Bob?
Yes, in part at least. We've already seen some relief in the bond market on some of the things you just mentioned. I suspect we'll get some more of that. And if the slowdown that I think we're beginning to see in the consumer unfolds some more, yes, we will get more rally in bonds and those rates should drop some.
Michael, I mean, we know Stephen Major is a bond bull. He's still at 3.5% for the end of the year. So he's not throwing in the towel on where we go. I think it's about timing, and it's about understanding the timing of the Fed and the slowdown, the potential slowdown, which it feels like there is a mini impact of the long variable lag. Does that build the case for you? If you want to sell vol, I'm curious to know, is that all vol, or would you consider selling some bond volatility as well?
Well, look, we've had very elevated bond volatility, first through, an unbelievably aggressive high velocity hiking cycle, which started 2 years ago. And then we had some sort of term premium related bond volatility last summer, last fall. I do think, as I mentioned, that if we're going into a tweaking cycle, bond vol should fall. There's one big caveat here, and this gets back to Steve Major's question about buying the back end of the curve right now. And I think it's an under-discussed topic, but the elections are less than 6 months away right now. And I think when you consider that, while inflation has been the Biden campaign's Achilles heel, I don't see much policy being articulated out of either side that's going to aggressively say this is how we whip inflation, right? There, I mean, Trump will talk about it, right? But if anything, you see the policies that from the Trump side so far have been more incrementally inflationary than from the Biden side, tariffs and having a much more aggressive view on the immigration situation, right? So those are both marginally inflationary here. And so I think given that the term premium, which got to 45 basis points on the Fed's ACM model last October, we're at basically 0 right now. Yeah. So all the increase in yields in the back end of the curve have been driven by other factors, right? Really more about Fed repricing, the repricing of the Fed's interest rate situation this year. If we start building in term premium here, and maybe that happens as we get closer to the election, and people start realizing that, what I think the real story is not what do equities do in November, but what do bonds do in November, then I think that's where I would take issue with Steve.
Well, we're going to have, Bob, let's just react to that. We're going to have a lot more discussion I would say, from Trump, et cetera, around the Inflation Reduction Act, around the CHIPS Act, around the fiscal spend from this current administration. And as you say, Michael, it could well be more discussion around immigration. They're going to be very pressing issues as we go to the election. Bob, with that in mind, if the left tail risk of a rate hike has been perhaps closed off by Powell, maybe we need to refocus on the left tail risk, which is fiscal. And fiscal came to bite us in the proverbial in last autumn. Is that the left tail risk that takes you back to 5% on 10-year government bond yields between now and the election or just after?
Could very well happen. I think you both pointed out how little discussion on policy we've had. I hope we have more discussion in the next 6 months, but there's a chance there's not a whole bunch more. But look, we know the fiscal situation is not tenable long term. And if that is the country, doesn't do anything about it, the bond vigilantes will come along at some point and hit us over the head. We cannot sustain this policy and expect rates to stay in the current place. And you put some tariffs on there, you put reasonable economic growth, and the path for interest rates will turn back up if we don't get economic weakness.
Yeah, we just need to get a quant model in place to do the equal and opposite of a Truss moment, a Liz Truss and Kwasi Kwarteng moment in the US bond market. I know it's deep, I know it's liquid, I know it's a different market, but I'll just put it out there from an Irishman to two Americans. Good morning, Michael Purves and Bob Dole. Thank you for joining me. Let's look under the hood of the stocks. We know that these chips are bid. Abigail Doolittle will take us through the moves. Abby.
It's not just chips that are bid. Let's take a look at the shares of Novavax. Extraordinarily bid. This stock in the pre-market up more than 100% at the pre-market highs, up more than 200%. This on the news, of course, that Sanofi is making a $1.2 billion vaccine licensing deal. They will receive $500 million upfront, $700 million if all the development, regulatory, and launch milestones are met. In addition, Sanofi is taking a 5% stake in Novavax, so very good news for those investors in that company. NVIDIA, there is one of those chips you're talking about, Manus, up 1.3%. This, of course, ahead of their earnings report and on the heels of TSMC's very strong quarter sales. Investors playing that forward to NVIDIA, but Alphabet not so much, down 1.2%. Reuters is reporting that Microsoft-backed OpenAI search feature will be launched next Monday, and of course that could create some sort of competition for Alphabet's own search feature, of course the well-known Google.
Well, certainly that NVIDIA number is going to be fill or kill on sentiment on this earnings season. Abby, thank you very much. Coming up, Biden said to unveil new tariffs on China.
The reality is, given the prices of the Chinese EVs and what I've seen firsthand, it would be very tough from a competition perspective. Retaliatory definitely could happen. This Game of Thrones continues to play out.
We'll talk about the impact next on Bloomberg.
The retaliatory is the last thing that you need from a Tesla perspective. And I think this is something everyone's been waiting for, because the reality is, given the prices of the Chinese EVs and what I've seen firsthand, it would be very tough from a competition perspective. Retaliatory definitely could happen. This Game of Thrones continues to play out.
Great analysis there. Game of Thrones. Well, the Biden administration is set to unveil exactly what are the new tariffs on China. That will come as soon as next week. The reports say that tariffs will target EVs, batteries and other metals. They will not be across-the-board hikes sought by the former President Donald Trump. Joining me now is Bloomberg's David Welch. David, good to see you this morning. So, look, this is as much a political message as it is an economic protective message for Team USA. What is the threat to the U.S. auto industry?
Chinese have a huge advantage in developing the supply chain and battery technology, and all that leads to lower priced EVs that they sell in China. And they're also selling them pretty successfully right now in South America. They're selling more vehicles in Mexico. So in a way, they're already on the doorstep of the United States. And if they were to sell those vehicles here, it's just a huge threat to what General Motors and Ford are trying to do. They're trying to build their EV businesses. It's also a threat to Tesla. That's a lot of jobs here. And also think about the Toyota, Honda, Hyundai plants, Nissan plants in the U.S., the Mercedes and BMW plants here. Any vehicles exported here from China threaten those jobs. And that's an awful lot of jobs in the auto sector, plus the parts beyond that. So this is a message to union voters, to non-union blue-collar voters, that the Biden administration is looking out for them and looking out for their jobs. And also it is, look, it's trying to buy time for the U.S. automakers and even Tesla to keep building up their EV businesses and lowering costs, hence lowering their vehicle prices, so they can remain competitive for the day when Chinese vehicles do get here. And I think one day they will. But we've got to get, in this country, a supply chain that can lower costs of EVs to even try to be competitive with them. And the way to forestall their advantage and put off the day that they come here is through some pretty heavy tariffs. And I think that's what they're trying to do.
Yeah, well, I mean, look at Tesla's competition landscape in China already. It's slipping behind. It's having to cut prices there. Can we talk a little bit about Tesla? Because I'd like some clarity. I'd like some help. Last week, we saw the supercharger infrastructure and the people involved in that being shelved. And yet, overnight, we hear Elon Musk talking about wanting to put another $500 million into superchargers. And then I have BP speculated to be on the verge of looking at the supercharger infrastructure of Tesla. This is the tweet from Elon. Tesla will spend over $500 million expanding our supercharger network to create thousands of new chargers this year. So can you just clarify for me where we are?
Elon Musk is always really clear until the next day when he says the opposite of what he said previously. So look, I think part of the reason he may have cut some of those people is maybe the targets to expand previously weren't being hit. But look, Tesla needs to keep expanding their charger network, especially if they're going to share it with General Motors, with Ford, Toyota, and the others who've signed on to their charging standard, because their own customers, the company's own customers, are having a hard time getting access to their chargers. A lot of them, particularly in California, are very crowded right now, and people are having to wait. That's customer dissatisfaction. So if he wants to grow sales, if he wants to keep his customers happy, and if he wants to share this network and make a little bit of money off of it by letting other vehicle owners use it, they need more charging. And you're seeing the other automakers, too. They have money out there to expand their charging network with Tesla's standard. So, look, everybody needs to build this out, and Elon Musk knows that.
David, thank you so much. David Welsh on the very latest with Tesla and EV. Coming up, we'll take you through your morning calls. A little bit later on, David Lefkowitz joins me to weigh in on this equity market rally. Approaching the third week of gains, we can smell the record highs. Calls for you this Friday. HSBC upgrades 3M to a buy, expecting shares to benefit from improving macro environment. Next up, KeyBank upgrades Warner Brothers to overweight, seeing an upside from its direct-to-consumer business. And finally, Stifel downgrades Planet Fitness to hold, predicting a volatile few months of sales. Coming up in the show, David Lefkowitz joins me from UBS. We'll talk all things markets and this three-week rally on Bloomberg. These chips are on fire. TSMC is up as their sales rise by 60%. That sends a nice tone warning for NVIDIA next week. Owned by Geely, this is a Chinese car maker listing on the NYSE. The stocks are bid. We're at a three-week rush higher on this equity market. We're 1% off those record highs. Will it endure? And in many ways, that is going to come down to what happens in the bond market. You're looking at a very, very flat bond market at the moment. You've got Stephen Major greasing the wheels of research, as he says. They've shifted their timing on rate cuts from the Fed. 3.5% is still the forecast by the end of the year. So there's miles to go. Still a bull from Stephen Major. The oil market is also bid up this morning, up 0.6%. Goldman Sachs expect a extension to the OPEC Plus cuts. Middle East tensions, they're still there, but perhaps not as furious as they were. 107.77 is where we are on euro dollar. And again, that divergence trade is very prescient. The euro is holding up, even though people think you're going to get 3 cuts from the ECB versus 2 cuts in the Fed. There's one stock to watch at the open. A splendid performance from Novavax. The share is more than doubling after the company signed $1.2 billion licensing deal. Let's get the details. Abigail Doolittle.
This is super interesting, Manus, because not only is the stock absolutely soaring, it is the best day on record, not surprisingly, going back to when the company IPO'd back in 1995. And probably a lot of this has to do with a bearish short interest of 34%, because this deal essentially takes away some of the going concern that there was for operations that the company announced last year. Now, if we take it back to the pandemic, this company has developed a COVID vaccine, but they were late to the market, so essentially missed out on it. During the pandemic, it was a $200 stock. Even after doubling today, it's nearly a $10 stock. So clearly it has shrunk in a big way. So this deal with Sanofi really gives investors and the company a lifeline, that $1.2 billion deal. They will receive $500 million in upfront payments, along with $700 million if all of the development, regulatory, and launch milestones are met. In addition, Sanofi will basically have a 5% stake in Novavax. Not that that means that they'll be taking over anytime soon, but perhaps puts a few footsteps on the path in that direction. Investors really liking this news right now, up 120%. But again, I think a lot of it has to do with the short squeeze as those bears get squeezed out of the shares of Novavax.
It's pretty stunning, though, isn't it? OK, Abby, thank you very much. We'll see you before the end of the show on Sector Watch. Autos in focus as well. Elon Musk, we've been talking about this, touting plans to expand Tesla's supercharger network. This just a week after firing almost all the employees who ran that division. Alex Semenova, no easy task. We'll discuss what this means.
Yeah, it's not, Manus. I mean, quite the about face by Elon Musk here, just 1 week after he shocked both customers and other car makers by dismissing all the 500 employees who ran that supercharger network business. He's now saying that Tesla will spend $500 million on that business in a post on X. The head of BP actually, the head of BP's electric vehicle charging business actually told Bloomberg this week that they were eager to step in and work with any real estate partners that Tesla had abandoned when they made that announcement last week. And it wouldn't be the first time that Elon Musk has done such a turnabout. Back in 2019, if you remember, he did abruptly announce that Tesla would close almost all of its physical stores and move most of its sales online. And then just 10 days later, after landlords refused to break some of the leases with Tesla, he backtracked and he raised the prices on Tesla vehicles. So very in character for Elon Musk. Shares are slightly higher this morning, but the stock was down, of course, about 31% year to date through yesterday's close. But since closing at a 15-month low on April 22nd, the stock has actually run up more than 20% as investors cheered Tesla's earnings. Another source of support for shares today is, of course, the Biden administration planning to implement new tariffs on electric vehicles from China. If Tesla closes higher today, that will be the first gain in 4 sessions. Manus.
OK, all eyes down for that. Alex, thank you very much. Let's get back to the earnings. Akamai falling to its lowest level since July after posting disappointing results. Alex Webb can explain what they do and what went wrong.
Yeah, Akamai is very much in the business of getting content to your computer or to your smart TV. If you're downloading a game on your Xbox, if you're watching something on Netflix, there's a very good chance that it is being served to you through an Akamai network. And it's that content delivery network that is actually underperforming. It has been in long-term decline. The pace of that decline is a lot faster than the market had expected. The reasons for that, of course, are that more of the streamers are building their own networks. That's a way to reduce their costs. The increase in advertising on services such as Amazon Prime and, of course, Netflix itself means there's a little bit less audience for these things. That is meaning that the CDN business is slowing down. The other businesses, which it's trying to grow to compensate for it, namely security and compute, are actually doing pretty well. But the EPS forecast for the second quarter was between $1.51 and $1.56. The market was looking for $1.63, and that's why we're seeing a big drop in the shares today.
Well, there's certainly a brutal reaction there. Alex, thank you very much. All in context. More earnings. Yelp missing the estimates after the macro headwinds for the restaurants and growing competition from delivery platforms. Jess Menton has the latest. Talk me through it, Jess.
Good morning, Manus. Looking at Yelp, this is another read if you want to see how the consumer is doing. So this is a story where if you look at this stock, actually paired some of its steeper losses in pre-market trading, but it is still down a little bit more than 1%, so on pace for its worst day. In just about 2 days, that stock's down about 17% year to date. But what happened was it actually beat on those profit expectations for the first quarter. Actually, a lot of that was really due to its home services category. But when you look at more what's happening with the environment for restaurants as well as retailers, that's where the strength was weakening there. And so what forced the company to happen was it had to, unfortunately, pull back some of those expectations for the current quarter. And we've seen that time and time again this earnings season as companies have disappointed at times when you're looking at EPS and sales. So if you're looking at this for the current second quarter period, Yelp is projecting revenue between $350 million and $355 million. If you look at the consensus calls, however, it was for $358 million in revenue. So that's where that was missing for the current quarter. Another function that I like to use in the terminal, though, is looking at BI Go. You can look at the guidance tab. Gina Martin's team over at Bloomberg Intelligence has this. So if you look at the median performance for companies that have missed on EPS and sales guidance so far this quarter, it's actually punishing shares close to about 7% in excess of the broader S&P 500. So that's actually the worst going back to right before COVID based on the BI data history, though. But when you're looking at the executives at Yelp, a lot of this they've pointed to when it comes to issues trying to pay for wages and things like that, and also how that pressures those costs when it comes to advertising. So that's why you are seeing that stock under a bit of pressure here ahead and looking right after the opening bell, Manus.
Jess, thank you very much for the wrap up there. Well, stocks are rallying, as we've been saying. We've got earnings optimism and pockets of disappointment. The data supports the case for interest rate cuts. That's certainly building. Joining me now is David Lefkowitz. He is head of U.S. equities at UBS. You know, David, there's a great suspicion in me, call me old-fashioned, whenever the momentum just shifts so dramatically, 2 rate cuts, and suddenly we're talking about new record highs, 1% away, bonds are on fire. Are you a buyer of the exuberance? Good morning.
Good morning, Manus. Yeah, look, I would say in terms of U.S. equities, yeah, I think the backdrop remains pretty constructive, right? We've got a pretty good combination of durable economic growth, and that's now translating into improving earnings growth, and I think importantly, kind of a broadening out of earnings growth, and that's, you know, it's broadening out beyond just the Magnificent Seven. That's, I think, a clear message we're getting from the earnings season. And, you know, you guys were just talking about this, Manus, but the guidance has actually been pretty healthy. So the momentum we're seeing in the first quarter continues into the second. And then, you know, combine this good growth with, you know, here we get into the inflation question. You know, we've had some hotter inflation prints in the first quarter, but our view is that those are going to be temporary, and we're going to see the disinflation trends reassert themselves. So we think we're on pace for 2 Fed rate cuts this year. I would also stress, though, the bull case or the, you know, further upside in equities is not so much predicated on whether or not the Fed, you know, cuts 1, 2, 3, 4 times. I think the fact that they won't be hiking, that seems pretty unlikely. And in combination with the good earnings backdrop, that's really the constructive environment that we see.
Does that earnings outlook, and I know that you've got a 9% earnings growth for the full year this year, is that enough to get us to 5,500, which I know is your most bullish case? 5,200, we're at the money, we're at your target right now, and we will dance around this by a couple of hundred points. But can you tell me what takes me to 55, double nickel for the year?
Double nickel, I like that. Yeah, I would say, you know, there's a couple things. I mean, if the inflation comes in even better than what we're thinking, which is certainly a possibility, and that opens the door to even further Fed rate cuts, you know, just better access to capital, things like that, which should spur some further sort of real growth in the economy. You know, also just, you know, obviously AI has been a huge tailwind for this market. We're pretty constructive on AI. Yeah. But if we continue to see, you know, earnings expectations continue to ratchet even higher on that, that could be an upside case. So I think it's just a combination of, you know, more of what the base case is based on, which is good growth and improving inflation.
And by the way, jobs are plentiful, wages are grand, you know, unemployment is sub 4% and continues to remain there. Maybe yesterday was an anomaly. Let's pick up on the AI theme. Dan Ives was with us a little bit earlier on this morning. He's produced a couple of notes, and this is what he's saying about the AI theme. The eye-popping CapEx numbers have kicked off this software and cloud phase of AI, tidal wave of generative AI use cases. They're exploding. across the enterprise world. We believe the next phase in AI spending is now on the doorstep. I mean, it's amazing. I was at the sell-side forum yesterday here moderating, and it sort of blows your mind when you hear people talking about technology and the speed with which AI is literally changing. Can you take that narrative and explore for me how you invest around that, or how you're talking to clients about how to be deft in AI?
Yeah, so our recommendations in terms of AI is focusing on some of where the bottlenecks are, right? I mean, I think there's, it's clear that some of the semiconductors made by some of the leading manufacturers, those are in short supply when it comes to running these AI workloads. But there's also bottlenecks, sort of across the supply chain, whether you look at the needs in the data center, look at power needs, electrical equipment. And also, we also think it makes sense to have exposure to some of the companies that could be developing some of the applications that are really going to monetize this technology. So I do think it's broader than just looking at semiconductors and really even software, and looking at where are the bottlenecks to build out the infrastructure in order to support the AI applications. Down the road, it's going to be the applications usually are the winners. Whenever you see these technology transformations or these platform shifts, it's a little bit early to be betting on who those winners will be, but we think you need it makes sense to have a diversified basket of some of those application, those folks that are in the horse race, so to speak.
Yeah, it's good to have a runner and a rider in the race. David, thank you very much for being with us. Closing off, let's see if we can get through that extra 1% today. Maybe not on the S&P 500. David Lefkowitz of UBS on the markets. Coming up, Netanyahu vows to fight alone.
I've known Joe Biden for many years, 40 years and more. We often had our agreements, but we've had our disagreements. We've been able to overcome them. If Israel has to stand alone, we'll stand alone.
That conversation in context ahead on Bloomberg.
I've known Joe Biden for many years, 40 years and more. We often had our agreements, but we've had our disagreements. We've been able to overcome them. I hope we can overcome them now, but we will do what we have to do to protect our country. If Israel has to stand alone, we'll stand alone.
Pretty tough words there from the Israeli Prime Minister Benjamin Netanyahu, standing up to the narrative from President Biden on the war in Gaza. This is after Biden warns of a suspension of additional weapon shipments if Israel attacks Rafah. Amory Hordern is in Washington for us. Give me a sense of the conversations that you've had, Amory, over the past 24 hours about the differences. Is there a chasm? Is this political theater between two sides, Bibi versus Biden?
I think you can see there is, whether it's in public or behind the scenes, there's growing divide and division between Benjamin Netanyahu, the Prime Minister of Israel, and the Biden administration. And that was very clear this week when Biden talked about the pause in some of these bombs that were going to Israel. And he pretty much said he doesn't want to see an Israeli incursion into Rafah. This is very different than what we've heard from the administration in the past, which is that they had put proposals on the table for how almost what would be more acceptable to them on how Israel could go into Rafah to finish going after the remaining Hamas battalions. This sounds like Biden does not want to see any incursion, not even one of the proposals he put on the table. That's the public messaging. So you could see this growing divide. And then, of course, we get this punchy interview with Benjamin Netanyahu with Dr. Phil. And he says, if we have to stand alone, we will stand alone. One thing to note, though, Admiral Kirby yesterday, Manus, did say this is still just a pause when it comes to the weapons. But that growing divide continues. And we're also going to get, according to Axios, this report that we've been waiting on from the State Department, from Secretary Blinken, on Israel. And he expected to submit it to Congress as soon as today, according to Axios. And Axios is calling it a highly critical report about Israel's conduct in Gaza.
It's interesting that Netanyahu goes on to talk about the madness of the pro-Palestinian rallies here in the United States of America and talking about the sorry state of higher education. So certainly he had a chip at Biden on that. Amory, take this forward. For now, we don't know the scale of the delay in the weapons. Rafah over the weekend, we don't know what the situation is. What is the situation on the ground in terms of that million people trapped in Rafah? Have they begun to disperse to other areas? Where can they go?
Well, that's a great question, and that's also part of the concern, not just the domestic implications on the Biden administration. You know, you talk about what Netanyahu had to say about the protests. Axios also reporting that the Biden campaign has been getting calls and messages from some top donors that are concerned about potentially the shift in policy towards Israel. When it comes to the civilians on the ground in Rafah, the UN says some civilians have left. The issue is they would have to then go to the north, where already some of their homes are not in place. And this is why the Biden administration, beyond the domestic policy concerns leading up to the U.S. election, the issue they have as well is how densely populated Rafah is and how this is where more than 1 million people took refuge, and now they're asking them to once move again. That is their concern about what the impact could mean and the detrimental, devastating potential casualties we could continue to see in Rafah, which is why they say they're putting these bombs on hold.
It's the very essence of the argument as to why they have paused. Anne-Marie, thank you very much. Anne-Marie Hordern in Washington. Over to banking, let's take a chat about this. UBS is considering a reward system for investment bankers who refer clients, wealthy clients that is, to wealth management. The bank is looking to expand its invested assets and narrow the gap with, you got it, Morgan Stanley's Sally Bakewell is with me now. Sally, what exactly is driving these potential measures? I mean, there's a lovely line in this story. It's slightly more Credit Suisse-esque than it is UBS-esque.
Yes, that's right. I mean, these potential referral fees for investment bankers who attract new money to the lender's private banking unit are something that UBS has not done before, but it is something that Credit Suisse, under wealth management head Iqbal Khan, has tried as it sought to kind of foster closer ties between its wealth management and its investment banking units to help boost revenues. So here, this move, which remains under discussion, it shows how Chief Executive Officer Sergio Ermotti, who has made catching up with Wall Street rivals on their own turf a key part of his strategy. He's relying on the newly enlarged investment bank following its rescue takeover of Credit Suisse to help bring more global products and services to US clients.
OK, Sally, thank you very much. Certainly part of this story is about Iqbal Khan. Many have discussed his desire to drive leverage, but of course there were certain instances at Credit Suisse that came back to bite them. Bill Huang, Lex Greensill, to name but a few. Sally, thank you very much. Coming up, sector price action for you as we close out this Friday with Abigail Doolittle.
We're looking at an update for the S&P 500 today, a second update in a row, up 0.4%. Tech leading the way, up 1%. NVIDIA, a big player there, along with Broadcom, Microsoft, AMD. So a lot of those chip makers and names that you've been talking about, Manus. To the downside, communication services down about 0.3%. Alphabet, a bit of a drag. Most of the other sectors, though, sort of in between, but more to the upside supporting the gain. In fact, speaking of gains, we're up for a third week in a row for the S&P 500, the first time that we have seen that since February of this year. Interestingly, this week, all 11 S&P 500 sectors are higher. The top sector, though, utilities, up 4.2%. This is a defensive sector. Yields are higher, too. Typically, you're not going to have this sector climb with yields going higher. Some may see this as a signal that some investors are getting defensive and that there could be some sort of a pullback for stocks ahead. We don't know that that's going to happen, but that is one possible signal. And then, not surprisingly, financials are higher with yields up. We also have materials and industrials in the top 4 on the week.
It certainly is a solid week for stocks. Abby, thank you very much. Coming up in the show, market moving events to put in your diary right here on Bloomberg. To understand the bullish narrative in equities, 1, 2, 3. You have Taiwan Semiconductor sales up 60% in the month of April. That bids up the whisper number for NVIDIA, because this is going to quite literally be the definition of sentiment around AI. And that can fill or kill the overall trajectory for the back end of the year. AMD, we just put it in to balance out the three, but I'm being unfair. Stocks are bid across the chips. Roll it over. You're 1% away from another record high. How can you not want to be on board with risk if you believe 2 rate cuts come along and this soft landing? Or have we hit peak no landing? You need to debate that. Stocks are bid. This is how your diary looks for the rest of the day. This is UMich sentiment coming up at the top of the hour. Fed speak, more of it. You can't get enough. Logan, Kashkari, Goolsby, Barr throughout the day. Next week, it is about the retailers. Home Depot will tell you their numbers on Tuesday, PPI, and then CPI and retail sales on Wednesday. That's Countdown to the Open from New York. Good morning.